Hello friends, welcome to Sentishala and I am Aditya. Today I have been joined by my colleagues Anirudh and Faraz. Thank you Anirudh and Faraz for joining us today. We'll be discussing a very popular topic and something which is discussed very frequently with Centricity's set of partners, which is financial goal planning and asset allocation, and how both are very intricately linked to each other. We've often been told that India is a land of savers, but not a land of financial planners. And today, the topic of the discussion very much revolves around this particular fact. So, Faraz, what is your take on us being, predominantly savers, but not really putting too much stress on how important financial planning is for the future?
So, Aditya, saving and investing, they're two very different things altogether. So, we as Indians have been great as far as savings are concerned. And obviously, that is also slightly changing with the change of demographics, wherein people are believing more in consumption and instant gratification.
Yeah.
But then investing, I think so, we are far off. Because if you look at the latest statistics also, there are hardly 3.5 crore people who are investing into mutual funds.
Yeah.
So that's a very startling number with a population of almost 1.4 billion or 1.5 billion people. If only 3.5 crore people are investing into mutual funds, that is slightly alarming, and that goes to show that the discussion which we are going to have today is going to be very, very relevant for everybody.
Right.
So savings, so people save, and if you put it under the bed, there is something called a termite called as inflation,
Right.
which will eat into it.
Yeah.
So if you don't invest that money properly, and which is actually giving you good real returns, then the whole concept of saving, or the whole idea of saving is actually defeated.
Sure.
So you need to invest into an inflation-beating asset class over a period of time and get those returns. Unfortunately, most of us have been always skewed towards fixed deposits. So if you talk about your parents or my parents, historically, the preferred vehicle to invest was FD.
Yeah.
And most of the times it was actually not giving a great real return.
So, Anirudh, I would like to ask you a very simple question. Although we take saving as a concept for granted, what exactly is savings meant to be? As in, what is the purpose of saving? What are the risks that we're covering by saving money from our professional incomes or from our business incomes, anything? So, what is actually the purpose of saving?
Ajay, that's a very good question, Aditya. And I would like to start with a small story, very short story.
Yeah.
That there was a man who was standing at the crossroads, and he was unable to decide whether he wanted to go left or right. And he saw a man sitting under a tree, and he asked whether I should take the left road or the right road. So the man asked, "Where do you want to go?" He said, "I don't know." So he said, "Then how does it matter? So if I don't know where I want to go and why I'm saving, if I don't know my destination, my goals, I cannot plan for it." So the first step in goal planning or investments or even savings is what is my destination, why I'm doing it, right? Now, there are two kinds of risks in our life that we face. One is a risk of living short. There's emergencies, there's exigencies. They could be, uneventful, events which can...
Unplanned events. Yeah.
Unplanned events, right? And there could be disabilities. Now, that may impact your active income. So, there are two kinds of incomes as well, active income and passive income. Active income while you are earning. You may be in a business, you may be in a job, you have a salary, you have a earning. That can get impacted because of these uneventful events that happens in our life, right? And that needs to be covered for. So, the first risk is risk of living short, or they could be accidents, or they could be a risk on your active income.
So here I just like to add is that in case your active income is at risk, ultimately, if you're going through that journey, your passive income will also be at risk.
Yes. Thank.
So what we need to do and what we need to start with, because there are three basic steps of the goal planning process. One is to create a fund for emergencies. Two is to create a risk cover. And three, obviously, is to create a goal planning roadmap, which might be for a short-term purpose, a medium-term purpose, or a long-term purpose. So that is how this whole entire goal planning journey is to be undertaken. So as Anurag rightly said, that whether you have to go right or left, you have to know your destination. So these are the various stops to the ultimate destination. So point number one, again, I'll just repeat for everybody. First, create a fund for emergencies.
Right.
And we actually saw the use of it big time during the COVID period.
Correct.
Because there was a period wherein there were people who were losing their jobs, or the salaries were being cut, or the salaries were not being credited. Other than that, people who were living on, say, daily inflows, cash inflows, so people who were into trading,
Right.
shops, shop owners, if the showroom is not open, if the shop is not open, sales are not going to happen and the inflows are not going to happen.
Correct.
So you need to create an emergency fund for it. So this is one. This was the extreme experience what we had during the COVID period. But then there might be instances like, suppose somebody falls sick, you need a lot of funds, then you end up actually redeeming or withdrawing from your investments which you have actually made for a particular goal, which might be short-term in nature, medium-term in nature, or long-term in nature, and then you will be compromising on those goals.
So what we mean is that if you're not covered adequately for the cost of your life, or if you're not insured adequately for, say, your health or other purposes, then whatever savings that you've done for other goals can actually get compromised.
It can eat into your
long-term goals, and it can undo decades of hard work and patience in the investing process. So therefore, from what I've been made to understood by Faraz and Anirudh, is that the first two steps of financial goal planning is basically to have an emergency corpus for, say, 6 or 8 months of the expenses that you have in the household.
3 to 8 months.
3 to 8 months is the average, whatever I'm comfortable with based on the the person's risk appetite. Second is that one should be adequately covered for one's life and health, because these are both.
There's one more cover, Aditya, which we generally tend to ignore and which is very, very cheap to procure, which is accidental.
Which is accident insurance.
or
Because
disabilities.
correct.
It
So
can impact your active income.
active income.
Active and passive income does.
Right. So assuming that these two things are out of the way and we have adequately planned for both of these, then how do we go about what is quintessentially known as financial planning? So how do we go about planning something as short a goal as planning a vacation, say end of this year or end of next year, and something as long as retirement, or something as intermediate as buying a house? So how do we go about this process?
So Aditya, there, a very important concept plays a role. We call it SLR, safety, liquidity, and return.
Oh, I thought it was about statutory liquidity ratio.
So yeah, it is safety, liquidity, and returns, right? And they go hand in hand.
Right.
They cannot be isolated or separated from each other, right? So whenever we are talking about a goal, whether it is short term, medium term, or long term, right? And also, just to give an example, your long term goals could be retirement. Long-term goals could be your child's education, which is 15 or 18 years down the line. And short-term goals could be immediate requirements, say 1.5 years and down the line. It could be a vacation. It could be buying a car. And medium-term could be, say, you're married and you're buying a house within 5 to 10 years of the time. So it could be a medium-term goal.
Right.
So these are various goals that, we all have various, in our life cycle.
Yes.
Now, for us to plan for these goals, the important parameter is safety, liquidity, and return. Because you can't invest everything into equity, because equity has given the best returns.
And vice versa, we can't achieve long-term goals with fixed income.
Absolutely. Because inflation will eat away into it. So as, Faraz also was talking about saving versus investment. And if I save everything into cash, hard cash, or keep everything into a bank deposit, which is only earning about 5-6%, and my inflation is 6 to 7 or 8%, and the real inflation, which is hitting all of us, maybe about 10%.
In fact, Anirudh, I'd like to just tell you one thing. If you look at education inflation, it is in double digits.
Yes.
If you look at medical insurance, again, it is in double digits. So what I am made to understand, it is approximately 14%. So even though the inflation is perceived to be, say, 6% or 7% or 5%, what the data is being hinted, but then that is CPI data, which is for a particular
Or a basket of goods.
yeah. So, but if you look at, people like us who are going to have kids going to school or colleges in the near future, I think so. We should be very concerned with the education inflation.
Yes.
Point number 2, again, slowly, we are moving towards an age wherein we will or we might have to have medical care done for us. Again, if you look at that inflation also, as I said, that is also in double digits.
Correct.
So these are two very important things. So again, coming back to the last step, having medical insurance or having a risk cover is not enough. Having an appropriate risk cover,
Yeah.
that is very, very important. So people say, I'm sorry, I'm transgressing a bit, but then people say I have a medical policy for say 5 lakh rupees, and I have that is enough.
Yeah.
On the other hand,
That is being penny wise pound foolish. Yeah.
people also say that "Acha, I have a medical policy from my office, from my employer. So why should I take my own policy?" So obviously these are very, very detrimental thought processes. When you are going for a medical insurance, it should be an appropriate cover. And all of us know and all of us are wise enough that if one goes to the hospital, and obviously we would try to go to a hospital where the best care is taken, and obviously those are pricey hospitals.
Yeah.
So, a day's bill goes into lakhs.
Yeah. So I remember one of the leading insurance companies used to advertise something called "Kam Insurance Lene Ki Bimari," KILLB. So yeah, I can resonate with that. But coming back to
the point, sorry, coming back to the whole point, the discussion what we were having. So see, SLR, safety, liquidity, and return. These are 3 broad parameters which will decide where to invest for a short-term goal or a medium-term goal or a long-term goal. So I would say that suppose you are planning for a short-term goal, then what is the most important factor in SLR? It is liquidity and followed by safety.
Right.
So suppose you need to have certain funds after 1 year. So that liquidity window has to be that you cannot invest anything which needs a gestation period of more than 1 year. And 2, safety, because it's a very short span of time. So that particular asset class should not be very, very volatile. So the return should be the last benchmark. So suppose if I want a 20% return over 1 year, if these things are not possible,
Correct.
then you have to compromise either on liquidity or on the safety.
So these 3 things have to talk to each other. So another, I wanted to ask you something. So sorry to cut you short. So we've often, Faraz also mentioned this before, that there is a period where we earn active income, and then after we retire or we let go of our business or whatever professions are, then we rely on something called a passive income, where that we've accumulated over a period of time during our active work years, for retirement or for whatever purposes, or for recreation, or for generally leading a happy retired life. I've often heard about this concept of asset allocation, right? So I wanted to understand how these 2 things are linked to each other. So because when we are actively earning and we are putting away some money aside, it has to be invested, right? For it to somehow convert into passive income at the end of a vesting period, or at the end of the accumulation period. But when it is invested, should it undergo a thorough process based on my risk profile, etc., or how should one go about it?
Right. So Aditya, again, goal planning, asset allocation, and portfolio review, product selection, they go hand in hand. You can't actually separate one from the other. Once you have identified your goals, and we are talking about the risk of living long, right? Where your active income stops, say at the age of 50, 55, 60, 65, depending on what business or job you are in, right? After that, you're dependent on whatever you have accumulated so far.
Okay.
Now, the first goal is, how do you increase your accumulation, right? Your income is fixed, which can grow only at a certain pace, depending on your performance, bonus, incentives, if you are salaried, or on business, right?
And boss's blessings.
And boss's blessing, etc.
So this we are talking about the wealth accumulation.
Wealth accumulation, because that will define the wealth preservation stage.
Yeah.
So when we are in wealth accumulation phase, the time horizon is long. So my liquidity requirement is low in SLR, right? My safety requirement is low because my goal is 20 years, 30 years ahead. The most important parameter is return. And therefore, when I'm in accumulation phase, my goal is to maximize my returns for next 20, 30 years.
Correct.
And therefore, my asset allocation will be derived from that parameter, right? Having said that, it cannot be that I put everything into riskier basket because it also has to do with my risk appetite.
Correct.
While my goals may be to maximize my returns over a period of 20, 30 years, but if I don't have the capacity to, withstand the volatilities that come with market fluctuations, then I need to tweak my portfolio and asset allocation accordingly.
So risk basically is subjective.
Yeah.
What you might perceive as very, very risky, I might perceive it to be very, very safe.
Yeah.
So again, within the equity asset class also, we all of us know that there are various kinds of capitalizations and which come with their own merits and demerits.
Yeah.
So large caps, mid caps, small caps, micro caps, and then now obviously we are a very, very innovative lot. So we have bundled various products around these capitalizations and then themes and sectors. So what exactly or where exactly you have to invest? So a conservative investor might have less allocation towards small caps or micro caps and less towards thematic funds or sectoral funds. And aggressive investor might just plan more towards such asset classes.
So again, I think my own personal risk profile and my ability and willingness to take risk matters a lot when I am investing during that active phase.
Yes.
And also when I am investing during the preservation stage, because even then it does not mean that I'm taking out all my money and start going to enjoy everything in 1 year or a very short period of time. I have to kind of endure the entirety of my retirement, which could be from anywhere between 15 to 25 or 30 years also. So I have to invest at that stage also, but according to my risk profile and according to what my goals are then.
Right. Because Aditya, there's one more concept that comes into the picture when we are in the preservation stage.
Yeah.
Once we have taken care of our retirement, say 30, 40 years, as long as I live, my income that has been accumulated or investment coffers that has been accumulated takes care of my lifestyle as well as, whatever I want to do within my limits. There's also called as legacy planning or passing on to the next generation. And therefore, the preservation state doesn't mean that, whatever...
To utilize everything.
Yes, I have to utilize everything, or whatever I have, I take it out and park it into a deposit or a very safe instrument because now I'm only going to eat out of it. It also means that you let it grow further because you can pass it on to the next generation. So all these things will actually determine what will my asset allocation will be even post-retirement.
In the preservation stage.
In the preservation.
This is a very big mistake commonly what people make after retiring or when they're planning to invest the money which they have created over a period of time. What predominantly I've seen is that, again, people go super defensive at that point of time and they invest primarily into only interest-bearing securities. I don't say that is wrong. And when I say interest-bearing securities, that too the most conservative one, which is fixed deposit. And again, see, the good thing or bad thing about FDs is that one, yes, they are safe. But then if you look into it, they are also prone to something called as an interest rate risk. Aditya, if we go back to around 2 years back, an FD was fetching a return of around 5%. Right now, post RBI 7.5% enhancing the interest rates, now it is around 7.5%. So, but and now if we go down the line, say a couple of years or 1 year from now, okay, we don't know when, but then ultimately the interest rates will again fall because of...
It's cyclical.
It is cyclical. See, the expenses are just going one way, but the income on which you are dependent on is cyclical. So that is also a risk. So when it comes even to interest-bearing securities, you should look at various opportunities which will give you slightly higher returns. So again, there should be a bucketing on the debt securities also, or fixed income investments also. So one portion might go to fixed deposits. There is something called as bonds, which all of us know, which take away the long-term interest rate risk which is there in the portfolio, especially for retired people. So bond is generally for a period of 9 years or 10 years. And if you buy into that, that entire interest rate risk is kind of not in terms of volatility, but in terms of reinvestment risk.
Yeah.
That is going away.
In fact, for us, even during the active wealth creation phase or wealth accumulation phase, one is often made to understand that the only long-term instrument which needs to be in the portfolio is equity. And this is my personal view, that even during that phase and even when I'm completely willing and able to take the risk, there should be still some component of fixed income, which can be very little in the initial years of my career and then can somehow wane over a period of time as time progresses. And I can keep increasing fixed income as when I'm nearing retirement. Initially, at least, I should have some portion. Reason being that even equity is cyclical, for a very long period of time.
Very interesting.
Yeah.
So yeah, we start the goal planning journey with the bang and determination that I'm going to do a 20-year SIP and I'm not going to touch that money.
Yeah, the moment it corrects 20%, my all the determination goes out of the window.
Trust me, and this is statistical data. Most of the SIPs which get registered, they get discontinued after 3 years.
Yes.
And that is a very hard fact. We are talking about long term, and this is not even medium term.
Correct.
So we are giving up too early, and the reason for it is because we are getting too aggressive on the equity investment. What you were saying, that whenever there is a requirement, or we are not planning our investments properly, whenever there is a requirement. So people are missing one of those 3 steps. What we were talking about, emergency fund or risk cover or something or the other. So because whenever there is a requirement, and plus obviously this whole fear that I hadn't got a 20% return, let's move out
And probably enjoy the returns or whatever.
just give up too fast. So I think so even start investing small but be disciplined. And then again coming back, so over there, as you were saying, that there should be some portion of fixed income over there. So there are various instruments, again, short-term bonds also, and something which is a very, very innovative product, which is regulated by RBI, which is called P2P.
Yes, I have heard about
So
that.
that is also a wonderful way to have a very decent return, inflation beating return, a nice real return. So there you can actually park for your emergency funds or some part of it to actually take care of the short-term requirements which actually come into. And SIPs are also possible in such kind of investments also.
So the mantra essentially is to diversification across as many, not only asset classes, but product classes also as possible, and not to be fixated about only some kind of instruments.
Because Aditya, we have also seen there have been periods when equity has given almost zero or negative return for as long as 5, 6, 7 years or even 10 years. Now, China is a classic example, right? It's been more than 50, if I take last 15 years returns, it's almost negative for China, right? And if somebody is invested only and only in equity in China, they would have actually lost money, right? And therefore,
In fact, why you going to China? Just remember that period after subprime 2008 to around
Almost around 6 years.
yes. No, that was just
there weren't any returns. There weren't any returns in a very growing economy like India.
And in those periods, asset classes like gold, debt, fixed income, real estate, REITs, etc. have done very well. So if your money is actually allocated across asset classes and across product classes, it can provide a big shock absorber to your journey, which is 20, 30 years from now. And that is the most important thing, because if equity has corrected and some other asset class has protected you or given returns, you can reallocate or rebalance your asset allocation, and that's what it actually means. So keeping in so it's not that I have $100 and I have put 25 each and forgotten about it, because I have to keep looking at it on a quarterly and yearly basis, that which asset class has done well, which hasn't done well, and rebalance it. And that's where your financial advisors or planners or distributors come into.
So talking about financial advisors and planners and or the distributor that I'm working with. So I believe one of the main summaries of our discussion has been asset allocation and diversification. So can we safely assume that diversification means more and more instruments, more schemes in my portfolio? The more number of schemes I have, the better diversified I am. Is it a safe assumption to make?
Actually, Aditya, there's a word called diversification.
Okay.
Right?
That's very
Diversification.
This is good for me.
Yeah, and it was put by
I'll just break it. Worse.
So over diversification also doesn't help, because when we get into the thick of things, right? If I have 15, 20, 30 mutual funds which are into flexicap or whichever category, there'll be huge overlaps in them, right? And ultimately what you're doing is you're buying more
The same underlying portfolio in different funds.
in different funds. And
Names are different, but at the end of the day, you're buying the same stuff.
And when I have to make some crucial decisions with respect to what I have to do in terms of realignment or whatever, it makes it even more difficult, because then I have to look at so many funds to make the call.
absolutely.
Another, I'll tell you, it was actually amazing. I keep on coming across portfolios for review, and a few portfolios I've got is 1 crore portfolio, 75 funds.
Wow.
So this is hype diversification, and this is not the right way. So over diversification also kills your return, because it has to be a kind of fine balance between over diversification and too concentrated.
Yeah.
So generally what I've seen is around 10 to 15 stocks, depending upon, not stocks, I'm so sorry, mutual funds, depending upon the size of the portfolio. I think so that is enough. One more thing which somebody has to understand, that, but this is my favorite topic, so I keep on going towards it, is you have to create the entire portfolio also into two parts, a core portfolio and a tactical portfolio. And obviously we will not talk too much, but then the tactical portfolio is what will get you an alpha. Point number 2 is, we were talking about investment advisors. So what I would say, the main role of an investment advisor is not to suggest you the best fund.
Yeah.
And that is actually, from a regulatory perspective, he's not expected to do that also. His main duty is to control emotions, because ultimately investing is all about emotions, controlling your emotions. So there are basic 2 emotions what govern the investment journey, and we have kind of discussed it in various forms till now: greed and fear. So when the markets are doing great, and when the markets are very, very giving wonderful returns, and my friends are telling that I have got 20% return, or 30% return, or 50% return from a particular scheme, we also want to invest. Okay, without understanding that might not be the best time to start. And predominantly what most of the people do is they start, well, it is not the right time to start. And then they have a bad experience, and then they say, investing is not suiting me.
Yeah.
And I've come across many people like this, that the moment I started, the markets collapsed. So that is where the thing is. And then systematic investment will obviously help in this part of the journey. And 2 is fair, that suppose somebody had actually invested during that sharp fall during the COVID period, obviously there were other factors was actually, but there was that whole fear that what will happen tomorrow, the world will survive or not,
Correct.
the equity markets will survive or not, what will happen. But had somebody invested at that point of time, the returns the person has made is nothing short of spectacular.
Right.
So
Yeah.
just to summarize, you can't put the cart ahead of the horses. So basically you need to first define what you want to do, why you want to do it, and then choose various asset classes and products, right? So product selection cannot be the first thing. For example, a particular stock or a particular fund or a particular, product has done very well, and therefore let's buy it. That cannot be the product.
That's basically herd mentality of FOMO based investing.
Yes,
Which is,
it has to, go in that flow, in that process, that you first do your goal planning, you do your risk profiling, you do your asset allocation. And once you reach asset allocation, you start doing product selection. And as Faraz said, while creating that asset class and the portfolio creation, you can have a core and tactical portfolio. And in the tactical portfolio, of course, you can tweak or fine tune your portfolio depending on what the vagaries in the market are currently.
So, Anirudh, Faraz, we discussed very, very interesting topics here. We started out by discussing goal planning and asset allocation, but we ended up discussing many, micro topics within that. For example, active and passive investments, active and passive income.
It's all interlinked.
All interlinked. Things like wealth accumulation phase and wealth preservation stage. how asset allocation again is very intricately linked to goal planning, financial goal planning. So overall, a very, very interesting discussion. I'm sure our viewers will benefit greatly from it.
But before we close,
Yes.
I would just request you to reiterate the entire process of goal planning.
Sure.
So that I think so. Let's make it a hard point.
Yes. So if I can summarize it from, let's say, let me play a devil's advocate from a very, very layman perspective, is that the first step in the process of goal planning is to identify, like Anirudh also mentioned, in which direction I want to go, in which stage of life I am, what is my visibility, and what are my ultimate goals. Then I even begin to start about this process. When I'm starting about this process, the first step that I do is to create an emergency corpus for myself. So I'm either in a job or I'm doing some business, and I plan for at least anywhere between 3 to 8 months of advanced planning about what could be my household expenses or emergency expenses, and I create a corpus and set it aside. And with that corpus, earning a superior return is not my agenda. The idea is to have a safe corpus, inflation beating safe corpus, which can help me in bad times, which cannot be foreseen now. The second is, of course, the greatest risk one can, any human being can ever go through is any impediment to my life, health. So I have to have adequate cover and avoid come insurance lene ki bimari. I should have adequate cover in terms of both life as well as health, medical, because these are things where the inflation is really high, much above the average CPI in our country. And then I move to the actual part of goal planning, which is my short, medium, and long term. Short term goals, of course, come and go, but the long term goals, of course, are things like retirement planning and children's education, marriage, etc. But then again, the very interesting concept that you mentioned is that we often tend to think that the only risk is the risk of living short, which is covered by insurance, whether it be life or health. But the even greater risk, and with advancements and God willing, the advance in medical technologies, that the life expectancy will keep increasing in our country also, and there is a very blatant upcoming risk of one living longer than one has expected, and one running out of money and running out of my typical Indian retirement plan, which is my children. Right, and in that situation, I end up having no money, and I can't earn active income also at that place. So not only the wealth accumulation phase, but the wealth preservation stage becomes even more important. What should be my investing strategy at that point of time? How will the portfolio be able to generate income which is enough to support my my preferred lifestyle, etc. So and there the concept of asset allocation again comes into play. And this is how all of it is kind of interlinked.
And lastly,
Yeah, sure.
very big risk which our current generation is facing is they have forgotten one fact, that whatever they are earning right now, it is their future earning also which they are getting right now. So what I mean to say is the jobs which we are having, they are not pensionable jobs.
Yes.
Which was a thing with advantage with our parents.
Right.
So whatever we are getting right now, we have to save a very big and a very major part of it and divert it towards our long-term planning.
Inculcating a very active saving habit is a very important thing.
Yeah.
Even though we are seeing a overall shift in the economy from a predominantly savings-led economy to a consumption economy, savings, inculcating a nice healthy saving habit is always helpful and takes you far.
Necessary. That's very, very necessary, and that is why, as I said, there are not many SIPs which are getting stopped because people are not understanding the importance of the ultimate thing, which is retirement.
Absolutely.
And then the risk what we talked later on.
So thank you, Anirudh. Thank you, Faraz, for coming on this discussion. It's been very, very insightful. And thank you to my viewers for being very patient. And I hope this will help you a lot in interacting with your set of customers and clients to do and execute very effective financial planning and asset allocation for your set of customers. Thank you all. And have
in case you find this video helpful,
Yes.
please do give us a like.
please do give us a like. And thank you.
Thank you.
Thank you.